pull out your wallet for a second. Like, if you have a physical paper dollar in there, take it out and actually look at the text printed on it.
Right.
It says Federal Reserve Note. And then right above the seal, it says, this note is legal tender for all debts, public and private. We see this piece of paper every single day.
Oh, absolutely.
We trade our time, our labor, our lives for it. We just assume it represents this, fixed, unshakable reality.
Which is exactly what we're supposed to assume.
Right. But if you actually sit down and read the legal statutes that define what that piece of paper is, how it comes into existence, and how the government taxes you for holding it, you find something genuinely shocking. The foundational rules of our money and our tax system, they don't just bend. They actively, mathematically contradict themselves.
Yeah, it is an architectural dissonance that most people, frankly, never see. We operate under the assumption that the financial system is a highly engineered, coherent machine. But when you examine the statutory code, like the actual laws passed by Congress over the last century, you don't find a clean machine at all.
No, not even close.
You find a sedimentary rock of historical compromises.
Okay, let's unpack this, because our mission for today's deep dive is to go layer by layer through a massive stack of research detailing this exact legal architecture. We are going to look at the structural paradoxes built into the U.S. financial and tax systems.
Mm-hmm.
And we are going to see how those paradoxes dictate who holds wealth, who pays taxes, and why the math governing our economy might be leading us into a corner that we cannot legislate our way out of.
Yeah, and to really grasp the magnitude of this, we have to start at the absolute foundation.
Right, the absolute bottom layer.
Exactly. Before we can even analyze the tax code or the national debt, we have to establish what a dollar legally is. And the research points immediately to an ontological schism in the United States Code.
An ontological schism?
Right, meaning there's a deep, unresolved tension between the concept of money and the concept of currency.
Which, to anyone walking down the street are the exact same thing. Like, if I have money, I have currency.
Colloquially, yes. But in the realm of legal definitions and economic history, there are fundamentally different concepts that have just been forced into this really awkward marriage.
Okay, how so?
Well, historically, money implies an asset that holds intrinsic value. It is a store of wealth in and of itself, totally independent of a government decree.
Right.
For thousands of years, that basically meant physical commodities, usually gold or silver coin.
Sure. Things you can actually hold.
Right. Currency, conversely, is simply a medium of circulation. It is a legally defined unit of account that holds value, primarily because the state declares that it does.
Mm-hmm.
And, crucially, because the state demands it back in the form of taxes.
Okay, so money is a thing that has value, even if the government completely collapses, but currency is like a ticket the government issues to run the economy.
That is a highly effective way to conceptualize it. And the contradiction really arises when you look at how the U.S. Code attempts to define the paper dollars we use today.
Okay, lay it out for us.
Let's look at Title 12 of the U.S. Code, Section 411. This statute governs the issuance of Federal Reserve notes. It explicitly defines those paper notes as obligations of the United States.
Obligations, like an IOU.
Exactly. Furthermore, it states that these obligations must be redeemed in lawful money on demand at the Treasury Department or at any Federal Reserve Bank.
Wait, okay, stop right there. If the piece of paper in my pocket is an obligation, an IOU, that entitles me to lawful money, then by definition, the piece of paper itself cannot be the lawful money. A claim check for a coat is not a coat.
Precisely the logical trap. The law creates a distinct separation between the note and the lawful money it promises to deliver.
Wow.
Now, prior to the 1930s, this made perfect sense. Lawful money meant gold or silver. You could take your paper Federal Reserve note, hand it to a teller at the Treasury, and they would hand you physical gold.
Right, the paper was just easier to carry around.
Exactly. The note was merely a convenient, lightweight substitute for the heavy, intrinsic money.
But we aren't in the 1930s anymore. We went off the domestic gold standard in 1933, and we completely severed the international link to gold in 1971 under Nixon.
Which leaves Section 411 completely stranded in time. Because if you go to the Treasury today, slide a $10 Federal Reserve note across the counter, and demand your lawful money, as the statute guarantees, they cannot give you gold.
So what happens? Do they just laugh at you?
Well, legally, they look at a different part of the law. Title 31, Section 5103. This statute defines those exact same Federal Reserve notes as legal tender for all debts.
Okay.
So to satisfy your demand for the lawful money owed to you by your $10 obligation, the Treasury will simply hand you
Wait, don't tell me.
another $10 Federal Reserve note, or perhaps two fives.
That is absurd. So legally, the system is like paying off your Visa bill with another Visa card from the exact same bank. It's literally an IOU paying off an IOU. The obligation just settles itself.
It is a closed loop of semiotic logic.
Yeah.
An obligation is settled by the issuance of an identical obligation, basically in perpetuity.
But, does this actually matter, though? Obviously, we all just agree to use the paper and I can buy my groceries with it. Does this legal paradox actually affect the macroeconomy?
It fundamentally alters human behavior and market dynamics through a principle known as Gresham's law.
Oh, right. Bad money drives out good.
Exactly. When a population intuitively realizes that the currency they are forced to use is a self-referential debt instrument, like an endless chain of IOUs with no underlying intrinsic anchor, and when they see that the supply of this currency is constantly expanding, thereby diluting its purchasing power, they alter their economic behavior.
How so?
They instinctively separate money from currency in their own lives. They take the fiat currency, the paper dollars they earn, and they spend them as rapidly as possible, passing the depreciating asset to someone else.
So they use the currency for circulating, but they don't use it for saving.
Right. For saving, they seek out assets with tangible scarcity and intrinsic value: real estate, fine art, precious metals, or scarce equities. They hoard the good money, the hard assets, and eagerly circulate the bad money, the fiat obligations.
That makes total sense.
Yeah, the legal schism in the code mirrors the psychological schism in the economy.
Which I think brings up the phantom monetary standard from the research. We still have the Gold Standard Act of 1900 on the books. It's technically active legislation. The government still legally defines a dollar as a specific weight of gold, roughly 1.5 grams, right?
Yes. And this creates a persistent visual contradiction every time the U.S. Mint produces a gold coin. The government mints a physical 1-ounce gold coin and literally stamps a nominal face value of $50 on it. The state is acting as the ultimate authority of nominal value.
But the physical gold bullion in that coin trades on the free market for thousands of dollars. You would have to be completely insane to walk into a store and buy $50 worth of groceries with a 1-ounce solid gold coin just because the government stamped $50 on it.
Because the free market acts as the arbiter of real purchasing power. The state decrees one reality, but the mathematical reality of the market completely overrides it. The phantom monetary standard it's a ghost of a previous economic paradigm that the legal code hasn't fully exercised.
Wow. Okay, so our currency is a self-settling IOU wrapped in a historical paradox. If the fundamental unit of the system is this strange, contradictory instrument, we have to look at the entity that actually manages it. Let's talk about the Federal Reserve.
Let's do it.
Because if you ask the average person who runs the central bank, they'll usually say the government. But the research highlights that the governance structure of the Fed is basically a jurisdictional fever dream.
It really is. The Federal Reserve System is uniquely designed to blur the line between public authority and private enterprise. It is an amalgamation, a hybrid structure created in 1913 as a political compromise.
Right. Between who?
Between agrarian populists who wanted government control of money and East Coast bankers who wanted a privately run central bank.
And the result of that compromise is this bizarre two-tiered system. At the top, you have the Board of Governors in Washington, D.C. They are public officials. The president appoints them, the Senate confirms them, they testify before Congress.
But the operational arms of the central bank, the 12 regional Federal Reserve banks scattered across the country in cities like New York, Chicago, and Dallas, they are organized as private corporations.
This is the part that sounds like a conspiracy theory, but is actually just statutory corporate law. Commercial banks in a given region are legally required to purchase stock in their regional Federal Reserve Bank. The private banks literally own the central bank.
They hold the equity, yes. But to understand the contradiction, we have to look at what that stock actually entails.
Right, because it's not normal stock.
Not at all. In the traditional corporate world, if you buy equity in a company, you acquire 3 fundamental rights. First, the right to transfer or sell your shares. Second, the right to vote on the governance of the company proportionate to your ownership. And third, the right to a residual claim on the company's profits.
Like, if you buy Apple stock, you can sell it, you can vote at the shareholder meeting, and you benefit when the stock goes up or they issue a massive dividend.
Exactly. But the stock that commercial banks hold in the Federal Reserve violates almost all of those traditional equity principles. First, it is non-transferable. A commercial bank cannot sell its Fed stock on an open exchange, nor can it pledge that stock as collateral for a loan.
Okay, so it's locked up.
Right. Second, this equity grants the member banks absolutely zero control over national monetary policy. They do not get to vote on interest rate decisions, and they do not elect the board of governors.
Well, what about the profits? Because the Fed makes billions of dollars in interest on the massive portfolio of bonds it holds.
The dividend paid to member banks is strictly capped by statute, historically at 6%. It doesn't matter if the regional Fed has a record-breaking year of profitability. The member banks only get their capped dividend. All of the residual profits, the massive surplus you mentioned, are remitted directly back to the U.S. Treasury.
So it's essentially a mandatory illiquid bond that pays a fixed yield, but it's disguised as equity to give the optical illusion of private ownership.
It is a legal fiction designed to foster cooperation from the private banking sector while maintaining ultimate public retention of profits and policy control.
But wait, the rabbit hole goes deeper. Even if we accept that the public board of governors is really in charge, not the private banks, how independent is that board from the politicians? Because we are constantly told the Fed is an independent central bank.
We operate under a very strong public narrative of central bank independence. This narrative was solidified by the 1951 Treasury-Fed Accord, which supposedly freed the Fed from having to manipulate interest rates just to keep government borrowing costs low.
But the research points to a latent trapdoor, Section 10(6) of the Federal Reserve Act.
Yes, this is a fascinating statutory remnant. Section 10 states that whenever any power vested by the Federal Reserve Act and the Board of Governors appears to conflict with the powers of the Secretary of the Treasury, such powers shall be exercised subject to the supervision and control of the Secretary.
Wait, I need to make sure I understand the gravity of that. If the Fed chairman and the Treasury Secretary disagree on a policy that overlaps their jurisdictions, the law says the Treasury Secretary, a political appointee serving at the pleasure of the president, has the ultimate veto power.
That is the plain text reading of the statute, yes.
That is wild.
Now, historically, modern administrations have been incredibly careful never to formally trigger this mechanism. They rely on soft power, closed-door meetings, and the cultural norm of independence. But the fact remains that this legal override switch has never been repealed by Congress. It sits there in the code, a latent executive authority over a supposedly independent monetary body.
It's incredible. We have an unsellable private stock capping dividends at 6%, overseen by a public board that is secretly subject to a dormant executive override. Okay, so we've established that the dollar is a paradox and the institution managing it is an optical illusion.
Right. And now we must address the most consequential mechanism of all, how the money actually enters the economy.
Yes, how does the money get to me? Because the standard belief, the thing I was certainly taught, is that the government prints money at a mint, drops it off at a bank, and then the bank lends it to people. Or the other classic belief, I deposit $10,000 into my savings account, and the bank takes my $10,000 and lends it to a guy down the street to buy a car.
Both of those models are fundamentally incorrect representations of the modern financial system.
Completely wrong, huh?
Completely. In our architecture, the vast majority of money is not created by the government printing press. It is created endogenously.
Endogenously, meaning from within.
Exactly. From within the commercial banking system itself through the extension of credit.
Walk me through the exact mechanics of this. Say I go to a bank and I want to buy a $500,000 house. I sign the mortgage paperwork. Where does the $500,000 actually come from?
It comes from nowhere.
Nowhere.
Nowhere. The moment you sign the promissory note, your legal pledge to repay the debt, the bank simply opens its ledger and types $500,000 into your account. They do not go down to a vault and move physical cash. They do not take money out of another customer's savings account.
So what are they doing?
They expand their balance sheet. On the asset side, they record your loan because you owe them money. On the liability side, they record the new deposit they just credited to you.
They literally keystroke the money into existence.
They create new purchasing power out of thin air, backed entirely by your future promise to labor and repay the debt. That specific act of commercial lending is what increases the total money supply in the economy.
And this leads us to what the research identifies as the most profound structural contradiction in the entire monetary system, the principal interest gap.
Yes, this is the mathematical paradox at the heart of our debt-based economy. Let's return to your mortgage. When the bank keystroke that loan into existence, it creates the principal amount. Let's assign that the variable P. The $500,000 now exists in the world.
Okay, P exists. Got it.
But the contract you signed legally obligates you to pay back the principal plus interest over the next 30 years. Let's call the total interest I.
Which, on a 30-year mortgage, could easily be another $500,000.
Exactly. Now consider the macro implication. The bank created the money for P, but it did not create the money for I. The money to pay the interest was never keystroked into existence.
Like, if they only created P, but I owe P plus I, where do I get the money to pay I?
You have to go out into the economy and capture it from someone else. You have to earn it through your labor, your business, or selling an asset.
But if every single loan in the economy works this way, if every dollar in circulation was created as principal P, but every borrower owes P plus I, then mathematically, at any given second, the total amount of debt owed in the economy is vastly larger than the total amount of money that exists to pay it.
That is the unavoidable mathematical reality of endogenous money creation. The system is inherently short of the liquidity required to settle its own obligations.
That's horrifying. It's like a massive game of musical chairs, but instead of taking a chair away, the music stops and the rules dictate that 2 new players have to join the game just to keep the current players from being eliminated.
It creates a treadmill of exponential expansion. For the economy as a whole to service the existing debt, to find the money to pay the interest, new loans must be constantly issued. Someone else has to walk into a bank and borrow new principal P so that those new dollars circulate into the economy, allowing you to capture them and pay your interest, I.
And if they stop borrowing, like what if everyone suddenly decides to be financially responsible, pay off their debts, and stop taking out new loans?
The money supply would physically contract. Because when you pay off the principal of a loan, that money is effectively destroyed. It is wiped off the bank's ledger, just as simply as it was created. If new borrowing slows down while old debt is being retired, the pool of circulating currency shrinks.
And because there wasn't enough money to pay the principal and the interest to begin with, a shrinking money supply means mass defaults aren't just a result of bad business decisions, they are a mathematical certainty.
This is why the modern economy requires endless perpetual GDP growth. We must consume more, build more, and borrow more year after year simply to stave off a debt deflationary spiral. The architectural mandate of the monetary system is infinite exponential growth.
But surely the central bank puts a leash on this. I mean, in economics class, they teach the money multiplier. The idea that banks are required by the Fed to hold a certain percentage of reserves, say 10%, which mathematically limits how much new money they can keystroke into existence.
That textbook model is entirely obsolete. The research highlights a quiet but monumental shift that occurred in 2020. The Federal Reserve officially reduced reserve requirements to 0%.
Zero? Wait, so there is no statutory limit on how much money a commercial bank can create?
Under the modern ample reserves framework, the binding constraint on lending is no longer a reserve requirement. Banks make the loans first, credit the accounts, create the money, and then if they need reserves to settle transactions with other banks at the end of the day, they simply borrow them in the federal funds market or directly from the Fed.
So what does the central bank actually do then?
The central bank has largely abandoned trying to strictly limit the quantity of money. Instead, they try to regulate the system solely by adjusting the price of money, the interest rate.
They just tweak the dial on how expensive it is to borrow, hoping that deters people.
Okay.
Let me synthesize where we are. We have a legally contradictory currency managed by a paradoxical institution, which pumps out debt-based money that mathematically demands infinite growth just to avoid self-destruction.
That is the monetary side of the ledger, yes.
Right. And now we have to look at the other side. How does the government claw some of that circulating money back to fund its own operations? Enter the United States federal tax system. And if you thought the banking rules were a maze, the tax code is where these systemic contradictions become deeply, sometimes painfully personal for you, the listener.
The tax system is the interface where macroeconomic policy collides directly with individual human behavior. And the most glaring structural issue here is what policy analysts refer to as the shadow budget.
I had genuinely never heard this term before reading the research. We all know about direct government spending. You know, the president submits a budget, Congress argues over appropriations for the military, infrastructure, education. It's highly visible.
Direct spending is highly scrutinized because it requires writing a physical check from the Treasury. But there is a parallel universe of government allocation known as tax expenditures.
Tax expenditures are the deductions, the exclusions, the exemptions, and the credits buried inside the tax code.
Correct. A tax expenditure represents revenue that the government legally would have collected, but intentionally chooses not to collect in order to incentivize a specific social or economic behavior.
Like the mortgage interest deduction to encourage homeownership, or the child tax credit to help families?
Exactly. But the mechanism is what matters here. When Congress appropriates direct spending, it is usually capped at a certain dollar amount and must be debated and renewed annually. But tax expenditures are drafted by entirely different committees, like the Senate Finance Committee. Once a deduction is coded into law, it functions as a permanent, uncapped entitlement. It rarely receives the same annual budgetary scrutiny as direct spending.
Which means it grows in the shadows. And the scale of this blew my mind. The research cites a Joint Committee on Taxation report from 2007. Just in that year, tax expenditures totaled $1,034 billion, over $1 trillion of revenue intentionally bypassed.
It is massive.
To put that in perspective, that shadow budget was more than 6 times the size of the entire federal deficit at the time.
And because this shadow budget operates in a silo, decoupled from direct appropriations, it frequently creates absurd policy dissonance. The government will spend money to achieve one goal while simultaneously offering a tax deduction that incentivizes the exact opposite behavior.
The dairy farmer example. In the outline, it mentions the 1980s. Walk us through how ridiculous this got.
In the 1980s, the U.S. government decided there was an oversupply of milk driving down prices. So the Department of Agriculture initiated a direct spending program. They paid farmers cash grants to cull to slaughter their dairy herds in order to reduce production.
Direct spending to shrink the herds.
Okay, but simultaneously, buried in the tax code, were investment tax credits and accelerated depreciation schedules for agricultural assets. These tax expenditures actively subsidize the cost of acquiring new dairy cows and expanding agricultural facilities.
So Farmer A is cashing a check from the Agriculture Department to kill his cows, and Farmer B is using a tax loophole to buy more cows at a discount. The right hand is fighting with the left hand, and the taxpayer is funding both sides of the war.
It is a textbook example of systemic incoherence.
But if this shadow budget is so inefficient, so hidden, and creates such contradictory policies, why on earth do politicians continue to expand it? Why not just use direct spending for everything?
The answer lies entirely in political optics. In the American political landscape, passing a new direct spending program is frequently attacked as expanding the size of government or welfare. It is politically precarious. However, achieving that exact same economic intervention through tax deduction can be branded as a tax cut. It provides the illusion of a smaller, less intrusive government.
But mathematically, it's identical. If the government decides it needs $100 to run and it gives a $10 tax break to a specific industry, it still needs that $10.
Exactly. Economically, a tax subsidy must be financed in the exact same manner as a direct grant. The government must either raise taxes on everyone who didn't get the loophole, cut direct spending somewhere else, or increase the national debt. A tax expenditure is just government spending disguised as revenue forfeiture.
And that burden, shifting, making someone else pick up the tab for the loophole, brings us to the equity matrix. How do we determine if the tax burden is distributed fairly?
Tax policy generally evaluates fairness through 2 lenses: vertical equity and horizontal equity. Vertical equity suggests that taxation should be based on the ability to pay. As a person's income increases, the percentage of their income paid in taxes should also increase.
A progressive system. The more you make, the higher your bracket.
Yes, the federal income tax attempts to achieve vertical equity through its graduated marginal brackets. But the other lens is horizontal equity. This principle dictates that taxpayers who have the exact same economic standing, who earn the exact same amount of total value, should bear the exact same tax liability.
And the research shows our code spectacularly fails the horizontal equity test. Let's look at the hypothetical of Alex and Chris.
This is a perfect distillation of the structural bias. Consider 2 employees, Alex and Chris. Both generate $50,000 a year in total economic value for their employers. Alex works for a small business and receives the entire $50,000 as a direct cash wage.
So Alex takes home a $50K salary.
Chris, however, works for a larger corporation. Chris receives $45,000 in cash wages, but also receives an employer-provided health insurance policy valued at $5,000. Economically, they are identical. They both receive $50,000 worth of compensation.
But under the tax code, employer-provided health insurance is an excluded fringe benefit. It's a massive tax expenditure.
Therefore, Alex pays federal income taxes, state taxes, and payroll taxes on the full $50,000. Chris only pays taxes on $45,000. Despite having the exact same economic standing, the architecture of the tax code penalizes Alex simply because of the structure of the compensation package.
which violates the core principle of horizontal equity. But it gets even worse when you look at the payroll taxes themselves, the taxes that fund Social Security and Medicare.
Payroll taxes introduce a massive element of regressivity into the system. Unlike the income tax, which has graduated brackets, payroll taxes are levied at a flat rate from the very first dollar earned.
But they cap out.
Crucially, yes, the Social Security portion of the payroll tax only applies up to a specific wage-based limit. In 2024, that cap was $168,600.
Let's break down the math on that because it's wild. If you are a working class individual earning $50,000 a year, 100% of your income is subjected to that payroll tax. But if you are an executive earning $5 million a year in salary, you stop paying the Social Security tax in January. Only about 3% of your total income is subjected to that tax.
This creates an inverted dynamic at the top of the income spectrum. When you combine progressive federal income taxes with regressive payroll taxes, and then add in state and local sales taxes, which disproportionately consume the income of the poor, the overall U.S. tax system is significantly flatter than the statutory brackets suggest.
Okay, so the system treats two average wage earners differently based on how their compensation is packaged, and it hits the working class disproportionately hard with flat payroll taxes. But what happens when we zoom out entirely? What happens when we compare someone who makes their money working to someone who makes their money simply owning things? This brings us to Section 5 of the research. Two different games.
And before we delve into this, it is vital to emphasize that we are analyzing this purely objectively. We are not making a moral judgment on wealth. We are strictly examining the mathematical and structural realities of the Internal Revenue Code.
Right. We aren't taking sides on whether this is good or bad policy. We are looking at the mechanics. And structurally, the code treats the act of labor completely differently than the act of capital investment.
Fundamentally, the code separates income derived from physical or mental effort wages from income derived from the appreciation of assets' capital gains.
The numbers are stark. The top marginal tax rate on ordinary labor income is 37%, plus those payroll taxes. But if you make your money through investments, long-term capital gains, the top statutory rate is generally 20%, plus a 3.8% net investment income tax.
So immediately, there is a massive statutory preference for capital over labor. But even that discrepancy fails to capture the true structural advantage held by the ultra-wealthy, because the capital gains tax is only triggered by an event known as realization.
The realization principle, the idea that you don't owe tax on an asset that goes up in value until you actually sell the asset and realize the cash profit.
Exactly. If you own a house and its value doubles over 10 years, the IRS does not demand a cut of that newly generated wealth every year. They wait until you sell the house.
Which sounds totally fair and logical for a normal person. If I don't have the cash, how can I pay the tax? But the research details how the ultra-wealthy leverage this simple concept into a multi-generational wealth preservation strategy famously known as buy, borrow, die.
It is an incredibly effective, entirely legal arbitrage of the tax code. It exploits the intersection of the realization principle, the tax-exempt nature of debt, and the rules governing estate transfers.
Walk us through the 3 steps. Let's invent a hypothetical person, Sarah. Sarah starts a technology company in her garage. Step 1, buy. Or in her case, build and hold.
Sarah owns the founder's stock in her company. Over 20 years, the company goes public and becomes wildly successful. Her stock is now worth $100 million. Under the realization principle, because she has simply held the stock and not sold it, she owes zero income tax on that $100 million of immense wealth creation.
But Sarah wants to enjoy her wealth. She wants to buy a massive estate in Malibu, a private jet, and fund a lavish lifestyle. If she sells $20 million of her stock to buy those things, she triggers the 20% capital gains tax. She would have to hand millions of dollars to the IRS. So she moves to step 2, borrow.
Instead of liquidating the stock, Sarah approaches a major private bank. She uses her $100 million stock portfolio as collateral to secure a $20 million personal loan.
And under the tax code, loan proceeds are not considered taxable income. It is borrowed money. She receives $20 million in pure untaxed cash.
Furthermore, because the loan is backed by highly liquid premium collateral, the bank charges her an incredibly low interest rate, perhaps a floating rate around 2 to 4%.
This is the arbitrage. It is vastly cheaper for Sarah to pay a 3% interest rate to a private bank than it is to pay a 24% capital gains tax to the federal government.
Right.
She uses the loan to live like a billionaire, entirely tax-free.
Which brings us to the final, critical step in the sequence: die. Sarah lives a long life, maintaining her stock portfolio and rolling over her loans. When she eventually passes away, she leaves her remaining assets to her children. This triggers IRC Section 1014.
The step up in basis. This is the silver bullet of the whole strategy.
When assets are transferred to an heir upon death, the tax basis, the original purchase price used to calculate how much gain is taxable, is automatically stepped up to the current fair market value on the date of death.
Meaning, if Sarah's stock was originally worth $0 when she started the company and it's worth $100 million the day she dies, the tax code pretends her heirs just bought it that day for $100 million. All of that historical gain, the entire $100 million of growth, is legally wiped from the IRS ledger. It vanishes.
Her heirs can sell the stock the very next week for $100 million. And because their basis is $100 million, their taxable gain is $0. They pay no capital gains tax. They use a portion of the tax-free proceeds to pay off Sarah's $20 million bank loan, and they pocket the remaining $80 million, completely bypassing the income tax system.
It is stunning, and the scale of this loophole is massive. The research estimates that this single provision, the step up in basis, will cost the government $72.5 billion in foregone revenue in the year 2026 alone.
Now, defenders of this structural provision will argue that it exists to prevent double taxation.
Yeah.
Their argument is that these assets will be subjected to the estate tax, the death tax, so applying a capital gains tax as well would be punitive.
But the data in the research completely dismantles that defense.
Because very few estates ever actually pay the estate tax. The lifetime exemption has been raised drastically. For a married couple passing away in 2025, the exemption shields nearly $28 million of wealth from any estate tax whatsoever.
So for the vast majority of multimillionaires utilizing buy, borrow, die beneath that threshold, the wealth is never taxed as income, and it is never taxed as an estate. It simply passes through the generational threshold tax-free.
The structural disparity becomes incredibly apparent when you look at how different income brackets experience taxation. The data reveals that the tax system effectively captures and taxes nearly 100% of the true economic income of lower and middle income groups. Why? Because their income consists almost entirely of W-2 wages, which are taxed immediately.
But the system only captures about 60% of the true economic income of the top 1%.
Because roughly 40% of the wealth generated by the top 1% consists as unrealized capital gains, which are shielded by the realization principle and ultimately erased by the step-up in basis.
The math is undeniable. The architecture of the U.S. Code fundamentally treats the act of owning assets as vastly superior to the act of performing labor.
It is a profound structural reality that generates significant horizontal and vertical inequity.
Okay, so the ultra-wealthy can navigate these pristine, high-level strategies to minimize their exposure. But what about the rest of us? What about a regular citizen or a foreign worker just trying to follow the rules? This leads us to the jurisdictional minefields of the code, because the complexity isn't just about loopholes, it's about traps.
The complexity of the Internal Revenue Code creates overlapping and frequently contradictory jurisdictional boundaries. The clearest example of this is how the U.S. government defines residency.
You would think residency is a simple binary. Do you live here or not?
You would assume so. But the tax code completely bifurcates the definition of residency depending on which specific tax is being applied to you. Let's look first at the income tax. For income tax purposes, the IRS uses a highly mechanical, completely objective standard called the substantial presence test.
Right, this is just a raw math equation. It doesn't care about your feelings or your intentions.
The formula requires you to count your physical days present in the United States. You must be present for at least 31 days in the current year. Then, you calculate a weighted sum, all your days in the current year, plus 1/3 of your days from the prior year, plus 1/6 of your days from the year before that.
So if you are a foreign consultant or a digital nomad flying in and out of New York and London, you literally have to track every single midnight you spend on U.S. soil.
Exactly. And if that weighted formula crosses 183 days, you trigger a massive legal consequence. You are officially deemed a U.S. resident alien for income tax purposes.
Which means what?
Which means the United States suddenly claims jurisdiction to tax your worldwide income. It doesn't matter if you earn the money in London or Tokyo, the IRS wants their cut. Furthermore, it subjects you to draconian reporting requirements, like the FBAR, where you must disclose the details of all your foreign bank accounts under threat of massive penalties.
Okay, that is intense, but at least it's an objective mathematical formula. You can track your days and avoid hitting 183. But what happens if that person dies? How does the estate tax define residency?
This is where the structural schism occurs. For transfer taxes, the estate and gift taxes, the mechanical day counting formula completely vanishes. Instead, the law relies on a common law concept called domicile.
Domicile, which means what?
It is an entirely subjective standard based on intent. It evaluates whether you physically reside in the U.S. with the intention of remaining there indefinitely. The IRS looks at soft factors. Where's your family? Where is your primary doctor? Where are your club memberships?
Wait, I see the trap. So I could be that foreign consultant. I could cross the 183-day substantial presence test. I could live in the U.S. for years paying U.S. income tax on every penny I make globally. But I keep a home in my home country. Maybe I vote there. Then I suddenly get hit by a bus and die.
In that scenario, the IRS could easily audit your estate, look at your home country ties, and declare, yes, he paid us global income taxes while alive, but he lacked the subjective intent to stay here forever. Therefore, he's a non-resident alien for estate tax purposes.
Why does that matter? Does it change the tax rate?
It drastically changes the exemption. If you are deemed a U.S. domiciled resident, your estate is granted a massive exemption, roughly $13 million per person in 2025. You can pass $14 million to your heirs completely tax-free. But if the IRS classifies you as a non-resident alien for estate tax, that exemption plummets to a mere $60,000.
$60,000, that's nothing.
Anything over $60,000 in U.S.-situated assets, like a house in Florida or stock in U.S. companies, is subjected to a brutal estate tax, often approaching 40%. You are trapped in the jurisdictional gap between two conflicting definitions of residency.
It's completely contradictory. But the jurisdictional clashes get even wilder when the tax code intersects with immigration law. Tell me about IRC Section 7701B.
This is a profound example of two branches of federal law operating in complete operational dissonance. Section 7701B dictates that an undocumented immigrant, someone who has crossed the border illegally or overstayed a visa, who simply meets that 183-day substantial presence test, is legally treated as a U.S. resident for tax purposes.
Wait, the immigration system considers them illegal and is actively trying to deport them. But the tax system looks at the exact same person, shrugs, and says, "Welcome to the club. Please pay taxes on your worldwide income."
Exactly. The IRS even issues them an ITIN, an individual taxpayer identification number, to facilitate the collection of revenue. The federal government officially recognizes, accommodates, and taxes the presence of individuals that its own immigration enforcement arm is simultaneously seeking to remove. It is a stunning policy paradox.
Let's pivot to enforcement. Because reading all these complex rules raises an obvious question. How does the IRS actually enforce compliance? The official term the government uses is voluntary compliance, which is honestly a hilarious phrase. Please voluntarily give us your money, or armed agents will put you in a cage.
The concept of voluntary compliance relies on a complex psychological and legal balance. The enforcement mechanism behind it is primarily found in Title 26 of the U.S. Code, Section 7203. This statute makes it a federal crime, specifically a misdemeanor, to commit a willful failure to file a tax return or pay taxes.
The operative word there being willful.
Precisely. In the realm of criminal tax law, courts have defined willfulness very specifically. It means a voluntary, intentional violation of a known legal duty.
Known.
Yes, because the Internal Revenue Code is so phenomenally vast and labyrinthine, the courts have recognized that genuine confusion is inevitable. Therefore, an honest misunderstanding of the law, or a good faith belief that you did not owe taxes, is actually a valid legal defense against criminal tax evasion charges.
That is mind-blowing. So the sheer, unreadable complexity of the tax code actually serves as a legal shield, but only if you can afford to use it. If I mess up my taxes, the IRS just assumes I'm an idiot or a cheat. But if a billionaire with an army of lawyers gets caught aggressively hiding assets, their lawyers can just argue, "Your Honor, the laws regarding offshore trust distributions are so incredibly convoluted that my client simply misunderstood their duty."
It creates an asymmetry in criminal enforcement. The complexity that torments the average taxpayer provides plausible deniability for the sophisticated taxpayer.
Which brings us to tax morale. The research spends a lot of time on this concept.
Tax morale refers to the intrinsic motivation of the population to pay their taxes. Historically, the United States has enjoyed a surprisingly high rate of voluntary compliance, often above 80%, which is an anomaly given that the actual probability of facing an audit is frequently less than 1%.
People pay because they think it's the right thing to do. They trust the system. They see their neighbors paying. It's a civic duty.
But tax morale is fragile. The research notes that when citizens become increasingly aware of these structural paradoxes, when they perceive that the rules are fundamentally unfair or rigged, their motivation shifts. Compliance moves from being a committed civic duty to being capitulative. They pay only out of fear of state retaliation. Or worse, it becomes creative compliance, where taxpayers actively seek to subvert the spirit of the law through whatever loopholes they can find, rationalizing it by pointing to the behavior of the wealthy.
And the data on who actually gets audited absolutely destroys tax morale, because we aren't enforcing the rules equally. Let's look at the administrative realities of IRS audits.
There is a severe, documented administrative contradiction in how the IRS applies its enforcement resources. Historically, one of the most heavily audited demographics in the United States consists of taxpayers claiming the Earned Income Tax Credit, or EITC.
The EITC. That's a credit designed specifically to help lower-income working-class families. Why is the IRS hunting them down? Is there a massive epidemic of working-class tax fraud?
It is less about malicious fraud and more about structural administrative convenience. The rules governing who can claim a qualifying child for the EITC in situations of divorce or multi-generational households are notoriously complex, leading to a high rate of unintentional errors. More importantly, the IRS can audit these returns with incredible efficiency. They use automated, computerized matching systems to flag discrepancies in dependents. It requires very little human labor to generate an automated audit letter denying the credit.
It's cheap and fast to audit the poor. But what about the ultra-wealthy, the people utilizing the massive shell companies and offshore trusts?
Conversely, over the last decade, the audit rate for individuals with income over $10 million plummeted drastically.
Even though the Treasury Department issued a directive in 2020 demanding that the IRS audit at least 8% of those high-wealth individuals.
The Treasury can issue directives, but the IRS faces a stark operational reality. High-wealth individuals do not simply file a standard W-2. They utilize incredibly opaque networks of pass-through entities, global partnerships, and tiered trusts. To audit them requires highly specialized forensic accountants and sophisticated data modeling. The IRS simply has not possessed the budget or the elite personnel required to systematically untangle those webs.
The research puts it brilliantly. The system effectively audits lower-income taxpayers for arithmetic errors because it can be done by a computer, while it completely struggles to audit the super-wealthy for structural avoidance because it requires intense, manual, expert labor.
It is an enforcement bottleneck that exacerbates the perception of systemic inequity.
And it isn't just individuals who suffer under this complexity. Businesses are trapped in an entirely different maze. Let's explore the eternal struggle of business taxation, the blurry line between Section 162 and Section 263.
This represents one of the most litigated and subjective areas of corporate tax law. Under IRC Section 162, a business is allowed to immediately deduct all ordinary and necessary expenses paid during the taxable year.
If I run a business and I buy printer ink or pay my electricity bill, I deduct that immediately from my revenue. It lowers my tax bill this year.
Yes, that is a current expense. But under IRC Section 263, if a business makes a capital expenditure, an investment that improves the value of a property or adapts it to a new use, they cannot deduct that cost immediately. They must capitalize it, adding it to the basis of the property, and then slowly deduct it over a period of years or decades through depreciation.
Okay, that sounds logical in theory, but the research points out how incredibly subjective this gets in practice, specifically highlighting the Supreme Court case in IndyBGO.
The IndyBGO decision established a standard that an expenditure must be capitalized if it creates a significant future benefit for the taxpayer.
Significant future benefit. That is a completely arbitrary phrase. Let's test this. Say I own a massive industrial bakery. One of my commercial ovens, which is the size of a minivan, starts breaking down. I pay $50,000 to have a team come in, replace some worn-out gears, swap out the broken thermostat, and get it running again. Is that an ordinary repair deductible today or a capital expenditure?
A tax attorney would argue that it merely returns the oven to its ordinary operating condition. Therefore, it is a deductible Section 162 repair.
Okay. But what if, while they are fixing it, the mechanic suggests upgrading the thermostat to a digital smart system that makes the oven 5% more energy efficient? Did I just create a significant future benefit? Do I now have to depreciate that $50,000 over the next 10 years instead of deducting it today?
And that exact ambiguity is the crux of the problem. The IRS might audit you, claim it was a capital improvement, and issue a massive penalty. The line between a repair and an improvement is inherently blurry. Small business owners are forced to make operational decisions while guessing how an IRS auditor will interpret significant future benefit 3 years down the road. It generates constant, expensive friction.
Let's talk about friction in the tax rates themselves. In 2017, Congress passed the Tax Cuts and Jobs Act, the TCJA, a massive overhaul. And the selling point was that it was going to create parity, making the tax code fairer for small businesses.
The TCJA drastically lowered the top corporate tax rate, the rate paid by massive C corporations like Apple or General Motors, from 35% down to a flat 21%.
Which was a massive windfall for Wall Street. But what about Main Street?
Most small and medium-sized businesses in the U.S. do not operate as C corporations. They operate as pass-through entities like LLCs, S corporations, or sole proprietorships. The business itself pays no tax. The profits pass through to the owner's personal tax return, where they are subjected to individual income tax rates.
Which, as we've discussed, can go up to 37%. So suddenly, a massive multinational is paying 21%, while the local plumber running an LLC is paying 37%. That is the opposite of parity.
To mitigate that glaring discrepancy, Congress created IRC Section 199A, also known as the Qualified Business Income, or QBI, deduction.
Which does what?
It allows the owners of certain qualifying pass-through businesses to simply deduct 20% of their business income right off the top, effectively lowering their top marginal tax rate to roughly 29.6%.
Problem solved, right. Parity restored.
The research explicitly called this the parity myth. The QBI deduction is arguably one of the most violently complicated provisions ever added to the tax code. It does not apply equally. It contains labyrinthine phase-out thresholds based on total income. It relies on complex formulas involving how many W-2 wages the business pays or how much physical property it owns.
And it arbitrarily discriminates between different types of labor.
Yes. They kind of designate certain fields as specified service trades or businesses. If you are a doctor, a lawyer, or an accountant, and you make above a certain income threshold, you're completely disqualified from taking the deduction. But if you are an architect or an engineer, you are allowed to take it.
So the tax code is literally choosing which professions it likes better. And the ultimate result is a landscape of profound horizontal inequity. You could have 3 people sitting in the exact same building, generating the exact same amount of profit. The C Corp pays 21%, the qualifying pass-through architect pays 29.6%, and the standard W-2 wage-earning employee pays 37%. Identical economic value, completely different tax burdens.
And if that C corporation is a massive multinational, they don't even worry about the 21% domestic rate. They engage in global profit shifting.
The ultimate arbitrage, moving the money to where the tax isn't.
The data in the research is staggering. Multinational corporations exploit differences in international tax codes to shift their profits into low-tax or zero-tax jurisdictions. It is estimated that U.S. multinationals are responsible for roughly 29% of the $1.7 trillion lost globally to tax havens every single year.
How exactly do they do this? Let's use a hypothetical pharmaceutical company. They invent a new miracle drug in a lab in New Jersey.
The physical pill itself is incredibly cheap to manufacture. The true value lies in the intellectual property, the patent for the chemical formula.
So what do?
The U.S. parent company creates a subsidiary shell company in a zero-tax jurisdiction, like Bermuda, or a low-tax jurisdiction like Ireland. The U.S. company then legally transfers the ownership of that highly valuable patent to the Irish subsidiary.
Okay, the IP is now in Ireland.
When the U.S. company manufactures and sells the drug globally, the Irish subsidiary charges the U.S. parent company a massive royalty fee for the right to use the patent. This royal fee acts as an expense for the U.S. company, wiping out all their taxable profit in the United States.
The profits are shifted out of the U.S. as an expense.
And those profits land in the Irish subsidiary, where they are taxed at a fractional rate. The economic activity, the research, the sales happened in the U.S., but the taxable profit was structurally relocated to a haven.
The TCJA tried to stop this, right, with a bunch of acronyms, JIL, TI, and FDII.
Yes, the 2017 Act introduced a carrot and stick approach. The stick was GILTI Global Intangible Low-Taxed Income. It was essentially a minimum tax designed to capture profits that multinationals were shielding in these tax havens.
And the carrot?
The carrot was FDII foreign-derived intangible income. This was a massive tax deduction offered to U.S. corporations to incentivize them to keep their intellectual property domestically in the U.S. by lowering the effective tax rate on profits generated from exporting products tied to that IP.
Did it work? Did the carrot and the stick fix the system?
The research highlights that it merely created new avenues for arbitrage. The structural contradiction remains. Look at the data provided. In the pharmaceutical sector, a staggering 78% of the gap between the statutory corporate tax rate and the actual effective tax rate these companies pay still comes from utilizing low foreign tax rates.
Right.
GILTIs didn't stop the bleeding.
And what about the tech sector?
In the tech sector, 38% of their tax gap, the reason they pay so much less than the 21% statutory rate, is entirely legal and domestically driven by the FDII deduction. The government created a loophole to prevent them from using offshore loopholes.
The location of where the economic activity actually happens and where the taxable profit is recorded are completely decoupled. It perfectly illustrates how complex systems, when patched rather than fundamentally reformed, simply create new, more sophisticated avenues for exploitation.
Which brings us to the ultimate synthesis of all these contradictions. We must look at where these systemic flaws are leading us.
We've seen how the monetary system mathematically demands endless exponential debt just to pay the interest on the money it creates. We've seen how the tax system is a leaky bucket, riddled with structural loopholes, paradoxical definitions, enforcement bottlenecks, and massive shadow budgets that fail to capture the wealth the system generates. Now, we arrive at the culmination of the research. We bring you to the present-day horizon, 2026. This is where these two runaway trains, the monetary system and the fiscal system, are finally colliding.
To understand the collision of 2026, we have to start by understanding the impossible mandate placed upon the Federal Reserve. Congress legally tasked the central bank with two primary overriding goals: price stability, which means keeping inflation low, and maximum employment. This is known as the dual mandate.
But the sources refer to it as a dual mandate, DUEL, like two people standing back to back with pistols ready to shoot each other.
Because the two goals are frequently inherently contradictory. The Federal Reserve's primary tool to manage the economy is the interest rate. If inflation is running too hot, prices are rising too fast, the Fed must raise interest rates. This makes borrowing more expensive, which intentionally slows down the economy, cooling demand.
But slowing down the economy causes businesses to lay people off. Unemployment rises.
Exactly. Conversely, if unemployment is too high, the Fed lowers interest rates to stimulate borrowing and business expansion. But flooding the system with cheap credit can overheat the economy, sparking inflation.
The Fed is constantly on a seesaw. And the ultimate historical example of this tension is Paul Volcker.
In the late 1970s and early 1980s, the U.S. experienced severe stagflation, a nightmare scenario where a supply shock in oil caused massive inflation, while the economy simultaneously stagnated, leading to high unemployment. Both sides of the mandate were failing simultaneously.
So what did Volcker do?
Chairman Volcker proved that when push comes to shove, the dual mandate is actually a hierarchy. Price stability must win. He raised interest rates to unprecedented, agonizing levels. The prime rate hit 21.5%. He intentionally crushed the employment mandate, throwing the economy into a severe recession, bankrupting businesses and farmers, all to break the psychological back of inflation.
Because he understood that you cannot have full employment in a society where the currency is becoming fundamentally worthless. But the Volcker shock was purely a domestic crisis. The crisis outlined in the 2026 horizon involves a global paradox that is actively squeezing the Fed today, the Triffin dilemma.
This was identified by the economist Robert Triffin in the 1960s. The U.S. dollar operates as the dominant global reserve currency. The entire world needs dollars. Other nations need dollars to buy oil, to trade with each other, and to hold in their central banks as a safe reserve asset.
The world is addicted to the dollar.
But to supply the global economy with the massive quantity of dollars it demands, the United States must run perpetual trade deficits.
Let's walk through the mechanics of that. A trade deficit means we buy more stuff from other countries than we sell to them.
Correct. We import manufactured goods from Asia or Europe, and we pay them with U.S. dollars. Those dollars flow out into the global system, satisfying the world's demand for liquidity.
But here's the dilemma. That exact mechanical process hollows out the American industrial base. Because the world constantly wants dollars, our currency remains structurally overvalued compared to other currencies. That makes American exports incredibly expensive and uncompetitive on the global market. We export our currency, but we destroy our manufacturing.
And worse, as Triffin warned, if the U.S. keeps running massive trade deficits forever, exporting trillions of dollars, the sheer volume of U.S. debt held abroad will eventually undermine global confidence in the value of the currency itself.
But the political upside of this setup is what they call the exorbitant privilege. Because foreign nations accumulate trillions of US dollars from selling us goods, they don't just put those dollars in a mattress, they recycle them.
They recycle them by buying U.S. Treasury bonds. They lend the dollars right back to the U.S. government. This immense artificial global demand for our debt allows the United States to borrow money at incredibly cheap interest rates.
We get to consume more than we produce, and the world lends us the money to do it. It's a sweet deal until you hit the mathematical wall. Which brings us to the ultimate trap detailed in the research: fiscal dominance in the year 2026.
The statistics projected for 2026 represent a structural paradigm shift. The national debt of the United States has hit $38 trillion. To put that in perspective, that represents over 124% of the entire U.S. gross domestic product.
We owe significantly more than the entire economic output of the nation. But the total debt number isn't even the scary part. It's the cost to carry that debt.
Exactly. Because the Federal Reserve had to aggressively raise interest rates in the preceding years to fight off a massive surge of inflation, the interest rate the government must pay on that $38 trillion debt has skyrocketed.
The net interest payments, just the interest, not paying down a single penny of the principal, hit $1.1 trillion in 2026.
Let that number sink in. $1.1 trillion in pure interest. That consumes roughly 17% of all federal government spending. The United States government is now spending more money just paying interest to bondholders than it spends on the entire national defense budget.
Here's where it gets really interesting. This mathematical reality creates a trap that the Federal Reserve cannot escape.
The Fed is entirely boxed in. Let us look at their options. If inflation begins to rise again, the Fed's traditional mandate dictates they must raise interest rates to cool the economy.
But if the Fed raises rates, it automatically and immediately increases the interest rate that the U.S. Treasury has to pay to roll over that $38 trillion national debt. That $1.1 trillion interest bill suddenly becomes $1.5 trillion or $2 trillion.
The government would be forced to borrow massive amounts of new money just to pay the interest on the old money. This creates a terrifying feedback loop, risking a total sovereign debt crisis or a collapse of the bond market.
So raising rates bankrupts the government.
Right. Okay, what about option B? What if the Fed lowers interest rates to save the government?
If the Fed artificially suppresses interest rates to keep the government's borrowing costs manageable, essentially monetizing the debt by buying it themselves, they abandon their price stability mandate. They allow inflation to run rampant, mathematically destroying the purchasing power and the savings of the citizens.
This is the definition of fiscal dominance. The central bank has been captured by the math.
Monetary policy is effectively crowded out. The supposedly independent Federal Reserve can no longer make decisions based purely on the health of the macroeconomy. It is held hostage to the desperate fiscal needs of the United States Treasury. The system isn't broken by accident. It is trapped by the inevitable conclusion of its own structural mathematics. The principal-interest gap demands infinite debt. The tax code fails to capture the revenue. And now the interest on that accumulated debt dictates the fate of the currency. It's fascinating how different economic schools of thought view this terrifying 2026 reality. They look at the exact same data and come to radically different conclusions.
The interpretations are starkly divergent. Proponents of modern monetary theory, or MMT, look at this fiscal dominance trap and argue that the constraints are largely self-imposed illusions. They posit that because the U.S. issues its own sovereign, non-convertible fiat currency, it cannot technically go bankrupt in its own denomination.
So MMT says the $38 trillion debt isn't actually a burden. It's just a historical ledger recording how many dollars the government has spent into existence but hasn't yet taxed back. They argue inflation is the only real constraint, and we should use targeted taxes, not interest rates, to control it.
The Austrian School of Economics looks at the same scenario and diagnoses a completely different pathology. They argue that this 2026 crisis was absolutely inevitable and that the Federal Reserve itself is the prime culprit.
The Austrians say the Fed caused the fire?
They argue that by artificially holding interest rates at zero for decades, the central bank completely distorted the price of capital. This created massive malinvestment, fueled unprecedented corporate and government debt bubbles, and the inflation we are experiencing is simply the delayed, unavoidable consequence of that monetary expansion.
And the Keynesians.
Keynesian economists might point to the structural realities of the liquidity trap. They argue that when traditional interest rate cuts lose their efficacy, when money is cheap but no one wants to invest because demand is weak, the system is forced into a heavier reliance on government fiscal stimulus to stay afloat. They see the massive debt as a necessary, albeit painful, shock absorber to prevent a total collapse of aggregate demand.
Three different philosophies, one mathematical reality. We have to bring this all together. We started this deep dive looking at a $10 bill. We explored the contradictory legal definitions of money as an obligation settling itself. We uncovered the paradox of the Fed's pseudo-private ownership and the Treasury's secret override.
We examine the mathematical inevitability of the principal interest gap, demanding endless endogenous money creation. We mapped the shadow budgets and the glaring horizontal inequities of a tax code that favors capital over labor through realization loopholes like buy, borrow, die.
We navigated the jurisdictional minefields that trap average citizens while providing legal shields for the wealthy, and we arrived at the ultimate collision. A world in 2026 where the central bank is held hostage by the sheer weight of the government's interest payments.
The ultimate synthesis of this vast stack of research is a sobering realization. The United States financial and tax system survives not by resolving its profound structural contradictions, but merely by managing them. It relies on kicking the can down the road through continuous exponential credit expansion and increasingly complex legal workarounds. But the structural truth remains. Mathematically, a system built on exponential debt cannot outrun itself forever.
Which leaves you with this final provocative thought. If our entire global monetary architecture is built on a mathematical mandate that debt must grow endlessly, exponentially, forever just to pay the interest on yesterday's loans, what happens when that infinite mathematical necessity inevitably collides with a physical world that has absolute hard limits?
That is the defining economic question of our era.
Thank you for joining us on this deep dive. I hope the next time you pull a dollar out of your wallet or look at the frustrating deductions on your paycheck, you see the hidden contradictory architecture standing right behind it. We'll see you next time.